G'day everyone, welcome to FinChats. My name is Hoi,
And my name is Hugh.
and today we're going to talk everything about bond yields. And if you haven't caught the news, bond yields have been increasing instead of decreasing, and that's because central banks around the world have signaled that interest rates, the official interest rates, are going to be higher for longer. So we're going to explore some of the reasons why it's happening, and why you should care. So Hugh, can you just give me a little bit more background on why bond yields are increasing?
Yeah, sure, Hoi. I think, firstly, I wanted to explain what bond yields are. Perhaps you might not be familiar with what they mean, but essentially what a bond yield is, it is a coupon rate that a treasury bond would have if it traded at par. So essentially, this rate is extremely important because it sets the sort of risk-free rate that prices all financial market instruments around the world, so including equities and bonds, etc. And so when you have a higher bond yield, that means the risk-free rate is higher, and that decreases the present value of a security. And so with that background, why is it increasing? Well, as you pointed out, inflation expectations are quite high, and inflation is proving to be much stickier than market participants thought. We saw a disinflationary trend towards central banks' 2% target for developed economies around the world. But more recently, that inflation rate, both core and headline, has increased and rebounded. And that's caused a lot of headache for these central banks because their mandate is obviously to bring that inflation rate back down to that target quite aggressively. And so market participants are thinking, is this a potential policy error? And how much further does interest rates need to increase for this target to be met? But on top of that, there are a few other factors why that I wanted to point towards that I think, some people may or may not have heard of, but, oil prices are one big factor. Recently, over the past quarter, they've risen 30% with OPEC cutting supply. So that's naturally a increase to the headline rates for most economies. Secondly, you have workers and unions' bargaining power having increased. There's increased sort of, demand for wages to increase, because when you have inflation rising, you want your wages to increase by at least the same amount so that you maintain your real purchasing power. And workers haven't seen that, and naturally they're striking. We're seeing an increased number of strikes happening, not just in America, but across the globe. And thirdly, production is moving onshore. We're not outsourcing to China as much, which is a deflationary trend. The reason why it's deflationary is because you can reduce your cost of labor by outsourcing to cheaper sources of labor. And so that's another sort of short-term inflationary trend that we're seeing. A final point, actually, that I wanted to point out is that the US is also extremely indebted. They have $33 trillion in debt. And so that acts as it doesn't act as an incentive for countries like China to keep purchasing treasuries, because there's a higher chance of default. And obviously, the US hasn't defaulted ever, but the probability of that occurring is increasing. So when countries like China and Japan start buying less or selling these treasuries, that puts upward pressure on yields. And those collection of factors are reasons why yields are just racing so high. They're 4.6% now, the 10-year treasury, which is the highest of the year so far.
Now, I've heard of inverted yield curves, and I want to pick your brain a little bit about what it is and the impact, because usually in normal environment, the yield curve is positive, as in, you get a lower yield or rate, the short term that you go, and then the higher yield, the longer term that you go out. So what's happening with the inverted yield curve, Hugh?
Yeah, sure, Hoy. So as you said, naturally the yield curve slopes upward. And so the reason why is because long-term interest rates are meant to be higher than short. Why? Because when you lock up your money for a longer period of time, you expect to be compensated more for that because you don't have access to that capital in the short term. Long-term rates are also a reflection of inflation and growth expectations. So when the yield curve is inverted, you have long-term rates. When I say long-term, I'm talking 10 years plus. When those rates are low, then it signals that inflation expectations and expected expectations of GDP growth are much lower in the future. So coupled with higher short-term rates, that disincentivizes people to invest because it costs more, right? And so when you have less investment, less capital expenditure, that also decreases the investment part of aggregate demand. And so when you have high short-term rates and lower long-term rates, that is a recipe for a potential recession. And there's a phrase in markets where they say that the yield curve inversion doesn't always lead to a recession, but a recession has always been preceded by an inverted yield curve. So it is a signal, but it doesn't mean it will cause a recession, but it's something to look out for. And that's what an inverted yield curve is.
Some of us in the finance industry look at that data point, the direction or the slope of the yield curve, to get a sense of how pessimistic or optimistic the market is. And to the ordinary person on the street, they may not. Care about whether the curve is inverted or not. They may not even care or understand what it means even after the explanation. So why did we bring it up? Why talk about the inverted yield curve, Hugh?
Yeah, sure. So as I said, the yield curve or the inversion of a yield curve can often be a predictor of a recession, or more precisely, it could be a gauge for sentiment, really. When the yield curve is inverted, and the more inverted it is, the market becomes more open to the probability of a recession. And so when you look at it through that lens, then you can position yourself saying, well, if there's a potential recession, you can start, saving more, you can start spending less, etc. And it's often difficult for, people on the street who are not in finance to disregard this because it may look like just numbers on the screen. But I wanted to give an example where it actually does directly affect the average person. So with mortgage rates, especially if you have a country with a high portion of variable rate mortgages, let's take Australia, for example, you've clearly seen the impact of rising rates on these mortgage payments. More often than not, these mortgage payments have gone 3 or 4-fold, from 1% to 3, 4, 5%. And that's had a material impact on consumers' wallets and their ability to spend. Again, consumption is a component of aggregate demand, and that will weigh on GDP growth. The second sort of effect that these yields can have is on your investment portfolio. Again, take for example, if you invest separately, or if you had a defined sort of contribution plan like Australia does, you naturally have exposure to equities or bonds or whatever it is. Rising yields or an inverted yield curve directly impacts your investment portfolio. For those sort of in finance, more on the technical side, rising rates will typically negatively affect your long duration bonds. So if you held bonds that are 10 plus years in duration, you will see a big loss in capital. Similarly, with long duration equities, we're thinking about stocks like technology, where a lot of those cash flows come in the future, they're going to be negatively affected a lot. And so what we've seen is that a lot of people's investments portfolio have seen a massive decrease over 2022 when interest rates started to rise. Having said that, there are still a lot of opportunities that present themselves in the market. A lot of people are moving to shorter duration bonds, shorter duration equities, a bit higher quality companies with lower levered balance sheets, because they're able to sustain these higher interest rates. Again, these are more for, I guess, the stock pickers out there who really like their stocks. But otherwise, if you're in it for the long term, just make sure you have a healthy allocation to equities. Now, this is not financial advice. This is just my opinion. But more often than not, buying equities in the trough or the recovery phase of the business cycle is often a really good opportunity to increase your wealth over time. So yeah, that's the effect for consumers and people out there.
And that's why we should care about bond yields and inverted yield curves. So thanks very much, Hugh. So that's everything about bond yields for this week. If you like this type of content, make sure you like, subscribe, and comment, and hit the bell icon. So for the time being, we'll see you later.
See ya.